All right, welcome to The Explainer. Today, we're digging into the latest report card from America's biggest bank, JPMorgan Chase. And let me tell you, there's a really interesting puzzle hidden inside their record-breaking numbers.
So let's get right into it. When we look at a report card like this, we're not just looking at one company's performance. We're actually looking for clues, major hints about where the entire economy might be heading.
For the full year of 2025, the bank brought in a massive $185.6 billion in revenue. I mean, it's a staggering figure, but that one number, it doesn't even begin to tell the whole story.
To really understand what's happening here, we need to zoom in on the final 3 months of the year. And this is where a fascinating and, slightly contradictory picture starts to emerge.
On the surface, things look absolutely fantastic. The bank's revenue grew a really healthy 7% in the last quarter, hitting nearly $47 billion. But that's only half the picture.
Because here's the real twist. While that revenue went up by 7%, their profit, the money they actually get to keep, went down by 7%. Yeah, you heard that right.
So this is the central puzzle of the whole report. How can a company make more money, but somehow end up less profitable? To solve this, we've got to pop the hood and look at the different parts of the bank.
You see, JPMorgan isn't just one business. It's really a collection of powerful divisions, and believe me, they all had very different quarters.
And you can see the split right here on this chart. The investment bank, which serves the big corporations, was an absolute powerhouse, bringing in over $7 billion. But the consumer bank, the part that deals with everyday people like you and me, well, that tells a completely different story.
So here's the key. The bank's entire profit dip, it came from this one area, the consumer division. Their profits fell almost 20%, and the reason? A huge increase in what they call credit costs. So the big question is, why?
Well, it turns out this wasn't just a case of some general economic jitters. That huge increase in costs was almost entirely driven by one single, massive strategic move involving a very, very familiar name.
JPMorgan made a huge splash by agreeing to take over the Apple credit card portfolio. It is a multi-billion-dollar bet, and it's what directly hit their profit for this quarter.
And here's the price tag for that deal. JPMorgan proactively set aside $2.2 billion. Now, this isn't money they've actually lost. It's a massive financial cushion they've built specifically to prepare for taking on millions of new Apple Card customers.
To put it simply, a credit reserve is basically a rainy day fund for loans. So by building this cushion right now, JPMorgan is getting way ahead of any potential defaults from its brand new pool of customers. It's a proactive and, expensive safety measure.
So, while this move might sting profits in the short term, you really have to see the long game here. JPMorgan is positioning itself to be the financial engine behind a product that lives on millions and millions of iPhones. It is a massive strategic play.
So, with that huge strategic move explained, what does the bank see coming up on the horizon?
Well, their forecast for 2026 gives us some pretty fascinating clues.
Their forecast highlights 3 key numbers to keep an eye on. First, they expect about $103 billion in net interest income. That's the profit they make on loans. Second, they plan to spend about $105 billion. And finally, they're predicting a credit card charge-off rate of around 3.4%, which is just the portion of debt they don't expect to get back.
Okay, so let's decode this. Their income forecast is built on the idea that the Federal Reserve is going to cut interest rates twice in 2026. Their expense number shows they are still spending heavily to grow. We're talking bankers, tech, marketing, the whole shebang. And that charge-off rate? It suggests they think a few more consumers might have trouble paying their bills next year.
And this is exactly why we pay attention to this stuff. This isn't just some internal budget. When the biggest bank in the country places its bets on rate cuts and a slight rise in consumer stress, it gives us all a powerful glimpse into the economic future they are preparing for.
So, JPMorgan is charting its course for growth, betting on lower interest rates even as they prepare for a little bit of consumer stress. It leaves us with one final big question. Is this financial giant seeing a favorable wind that the rest of us on Main Street just can't feel yet?